I think he's a great prime minister. I mean, he could represent me anytime. I will tell you, I'm not saying that because he is a very strong, very good leader.
In Washington, the cameras captured another handshake, another round of smiles inside the Oval Office. President Donald Trump praised his guest, Prime Minister Mark Carney, and the two leaders spoke of friendship and trade. But behind those polite gestures, the stakes could not be higher. For months, Trump's tariffs have tested the economic bond between the United States and Canada. What began as an attempt to force Ottawa into a new deal has now exposed cracks in America's own economy. Factories are slowing down, prices are climbing, and key U.S. states that depend on Canadian energy and materials are feeling the strain. The October 7 meeting between Trump and Carney was meant to reset relations. It ended without a formal deal, yet it marked a quiet turning point. Canada did not yield. Instead, it used patience, economic leverage, and a sense of shared purpose to turn American pressure into a form of power.
Let's be clear about the relationship as it stands right now. We are the second largest trading partner of the United States. We do a lot of trade going across the border. Secondly, we are the largest foreign investor in the United States. $500 billion in the last 5 years alone, probably $8 trillion in the next 5 years if we get the agreement that we expect to get.
Canadian materials are deeply woven into American supply chains. Ontario steel goes into Michigan car frames. Quebec aluminum powers jet parts assembled in Ohio. When the tariffs hit, costs for those same American factories spiked overnight. Construction firms in Texas and Florida reported higher material prices by late summer 2025. Furniture producers in North Carolina warned of job cuts as imported wood components became too expensive to source. Meanwhile, Canadian exports slowed but did not collapse. Many firms shifted their shipments to Europe and Asia under existing trade pacts, while Ottawa cushioned affected sectors with targeted support. By September, the U.S. Chamber of Commerce and several Great Lakes governors publicly urged Washington to reconsider. They argued that the tariffs were fueling inflation instead of reducing it. Inside Canada, the mood changed from frustration to resolve. The public saw that Trump's strategy was not breaking Ottawa's will, but exposing America's dependence on cross-border trade. The message became clear: the harder Washington squeezed, the more damage it caused to itself. Unlike the United Kingdom or the European Union, Canada cannot rely on distance to escape American policy shocks. The two nations share the world's longest undefended border, a 9,000-kilometer lifeline through which goods, energy, and investment flow every day. Carney reminded Americans of what that relationship means. Canada is their second-largest trading partner and their single largest foreign investor, with more than $500 billion invested over the past 5 years. If trade tensions ease, those investments could reach $8 trillion within the next 5 years, according to figures discussed by both governments. This level of integration gives Ottawa a different kind of strength. Ontario alone supplies electricity to states such as New York, Michigan, and Minnesota, helping to power factories, hospitals, and homes. When Trump's tariffs raised costs for those same regions, Canadian leaders quietly reminded local governors that their economic stability depends on cooperation, not confrontation. At the same time, Carney's government began shifting incentives toward domestic manufacturing. Companies producing steel and auto parts were encouraged to use off-peak electricity for cheaper power, effectively redirecting energy that once supported U.S. industry. The symbolism was striking. Canada could choose to keep the lights on south of the border or turn that current inward to strengthen its own factories. Trump wanted leverage, yet geography and integration meant Canada held most of it. While Washington operated in crisis mode, Ottawa projected calm. Carney faced intense domestic pressure to strike a deal, but he resisted the urge to retaliate with sweeping counter-tariffs. Instead, he pulled back Canada's planned digital services tax, a gesture of goodwill that reopened dialogue. This approach contrasted sharply with the mood in the United States. The federal government remained partly shut down due to budget stalemates. Inflation was rising, and investors faced uncertainty over shifting tariff lists. By comparison, Canada's fiscal position was stable. International agencies kept the country's AAA credit rating. Its debt-to-GDP ratio remained the lowest in the G7, and the Bank of Canada maintained steady interest rates even as global markets wavered. The contrast was not lost on financial analysts. Stability had become Canada's best diplomatic weapon. While Trump sought quick wins through public pressure, Carney built credibility quietly, aligning provincial premiers and business groups around a single goal: keep trade channels open and prevent panic. Even conservative figures who opposed Carney politically, such as former Minister Peter MacKay and Ontario Premier Doug Ford, acknowledged that the Prime Minister had to succeed for the sake of the national economy. The consensus was rare, and it strengthened Ottawa's hand. By the time the October meeting concluded, the US and Canada agreed to maintain technical talks and pause further escalation. No one declared victory, yet the silence itself spoke volumes. Carney had managed to turn confrontation into cooperation without conceding sovereignty. At the heart of the standoff lies a truth both sides cannot escape. The two economies are built together. More than 60% of components used in American auto assembly plants originate in Canada, according to North American industry data. Quebec's aluminum and Ontario's steel remain critical inputs for U.S. aviation and construction. When Trump revived his 51st state remark, many Canadians saw it as an insult, but others recognized it as proof of how intertwined the two nations have become. Each tariff, each soundbite only underscored that separation would harm both. This reality reshaped the political landscape in the Great Lakes region. Governors from states like Michigan and Wisconsin, home to millions of workers tied to cross-border trade, openly opposed further tariffs. They called for cooperation on steel, autos, and energy rather than escalation. Canada's strategy was to highlight this shared dependency without turning it into a public feud. Through joint industrial meetings and energy briefings, Ottawa quietly reminded U.S. officials that integrated grids, pipelines, and manufacturing corridors cannot be rebuilt elsewhere without enormous cost. In effect, the North American supply chain itself became Canada's shield. Every car part crossing the Detroit-Windsor Bridge, every megawatt of power flowing south served as living evidence that partnership, not punishment, is the only sustainable model. Trump's tariffs may have been loud, but Canada's integration was louder in practice. When the second Trump-Carney meeting ended, there was no new trade deal to announce, yet Canada walked away stronger than before. It had protected its industries from escalation, rallied bipartisan support at home, and earned sympathy from governors, investors, and even segments of the American business community. The U.S. administration may still hold the tariff lever, but Canada controls something more durable: trust, consistency, and the quiet backing of economic facts. Trump's strategy to pressure Ottawa has instead revealed how dependent Washington remains on its northern neighbor. The story that began as a test of strength is turning into a lesson in interdependence. In the long run, tariffs can be lifted or replaced, but the networks of energy, labor, and investment that bind these two nations cannot be unmade. Trump wanted a headline victory. Carney aimed for endurance. And as the lights of the Great Lakes continue to glow on both sides of the border, it is clear whose approach is keeping them on.
And Canada called me a couple of weeks ago. They want to be part of it. To which I said, well, why don't you just join our country? You become 51, become the 51st state.
More than 70% of respondents feel that Trump's comments have strengthened Canadian pride. Close to 80% of Canadians would never vote to become part of the U.S.
When Donald Trump joked that Canada could become the 51st state, it might have sounded like a throwaway line from a campaign rally. But for Canadians, it hit differently. A new Ipsos survey for Global News found that nearly 80% of Canadians said they would never vote to join the United States, while more than 70% said the remark made them prouder to be Canadian. That statistic alone tells the story of a shift in attitude. What began as a jab from Washington has turned into a rallying cry north of the border. Trump's tariffs, his insults, and his brand of political showmanship have not weakened Canada. They have done the opposite. Across provinces, people are turning inward, thinking about what it means to rely less on the U.S. market. From lumber towns in British Columbia to battery factories in Ontario, the same idea is spreading. Canada can build, Canada can supply, and Canada can stand on its own. This new wave of determination didn't appear in a vacuum. It began with economic pressure, diplomatic tension, and a feeling that Washington had crossed a line not just in trade, but in respect. When Trump returned to power in January 2025, his administration launched a new wave of import duties on major trading partners. Canada was hit especially hard. By March 2025, Washington imposed 25 to 35% duties on key exports: softwood lumber, steel, automotive parts, and furniture. Even energy, long protected, faced a 10% tax. These measures, justified on security grounds, aimed to pressure Ottawa in the USMCA review. Instead, they damaged both economies. In British Columbia, cross-border traffic dropped for 8 straight months. Data from the Cascade Border Data Warehouse showed that between February and September, the number of BC vehicles heading south fell by 40% year over year. That decline reflected more than economics. Many Canadians said they no longer felt welcome in the U.S. Workers in the lumber sector stopped traveling south. Families canceled vacations. Meanwhile, small towns in Washington state, long dependent on Canadian shoppers, began to suffer. The Border Policy Research Institute warned the trend was alarming and could force local businesses to change how they operate. Trump's tariffs didn't just hurt Canada, they began eroding America's own border economy.
Right now, we're going to boycott it.
I am not interested in traveling to the States. Doesn't sound like a very nice place to visit right now.
The trade pressure might have been manageable on its own, but Trump's comments added a different kind of sting. During a public event in mid-2025, he claimed that Canada had called him wanting to be part of it. He followed with the line, "Why don't you just join our country, become the 51st state?" For many Canadians, that was the moment the debate stopped being about tariffs and started being about dignity. The Ipsos poll for Global News, conducted shortly afterward, revealed a national shift in mood. Nearly 4 out of 5 Canadians rejected even the idea of joining the U.S., and most said the statement had strengthened their pride in being Canadian. Political analysts say the comment touched a nerve because it came at a time when Canada's sovereignty was already under pressure. Trump had linked his 51st state quip to discussions about a joint missile defense system, something he called the Golden Dome. The suggestion that defense cooperation could come with a hint of annexation was viewed in Ottawa as deeply offensive. By the time Prime Minister Mark Carney prepared for his meeting with Trump in early October, the mood in Canada was unmistakable. The 51st state line had become a symbol, proof that the United States was no longer treating its northern neighbor as an equal partner. Instead of bending to that pressure, the backlash united the country. Across political lines, Canadians began to rally around one idea. If Washington wanted dominance, Canada would answer with independence. Ottawa's first step was economic retaliation. In March 2025, Canada imposed counter-tariffs worth about 30 billion Canadian dollars, matching Washington's duties dollar for dollar. The targets were deliberate: American steel, aluminum, household goods, and even symbolic products like lawn equipment and household tools. This move wasn't meant to escalate forever. It was designed to show that Canada would not remain passive. By early September, Prime Minister Carney announced that Canada would lift some of those counter-tariffs, but only for products compliant with the USMCA's regional content rules. It was a tactical signal. Canada would reward fair trade, not political coercion. The decision had immediate local effects. Cross-border trade in certain consumer goods improved slightly, and businesses in border towns like Blaine, Washington began to see Canadian customers returning. But the political message was unmistakable. Canada was taking the high ground, showing restraint while maintaining leverage. Carney's words summed up the new posture clearly. Canada is not for sale. That phrase became a headline across national outlets and a quiet statement of policy. Canada would negotiate but never surrender its sovereignty. Behind the scenes, Canada also began accelerating programs that could reduce dependence on U.S. supply chains. Provinces rolled out incentives for critical minerals, electric vehicle components, and defense manufacturing. Ontario announced a $17.5 million grant to Electra battery materials for North America's first cobalt sulfate refinery, designed to produce 6,500 tons a year, enough to power 1 million electric vehicles. At the same time, the federal government opened consultations to speed up mining approvals under the One Canadian Economy Bill, ensuring future projects wouldn't be stalled by the same bureaucratic delays that had haunted resource development for decades. The message was clear. If Washington wanted to weaponize trade, Canada would respond by weaponizing innovation and production.
As autumn arrived, a new narrative emerged. Trump's tariffs and remarks had backfired. They had driven Canadians to look inward, invest locally, and redefine sovereignty. Communities once reliant on U.S. buyers found new export partners in Europe and Asia. Ottawa expanded trade missions to Indonesia, South Korea, and the EU, focusing on diversification. Pollsters noted that national pride and support for independent economic policy had reached their highest levels in more than a decade. Even Canada's diplomatic tone shifted, less reactive, more strategic. Trump's pressure campaign, meant to extract concessions, instead strengthened Canada's resolve. His 51st state line, meant to assert dominance, only underscored the country's independence. Border crossings may have fallen, but investment at home is climbing. Public unity has grown stronger, and industries once tied to U.S. demand are finding their own footing. From Ottawa to Vancouver, one message echoes: Canada will not be intimidated. It will innovate. In the end, Trump's campaign of pressure did not weaken his northern neighbor. It gave Canada a reason to rebuild, not as a sovereign, but as a sovereign nation determined to shape its own future. That is the paradox of 2025. Every attempt to make Canada smaller has, in fact, made it stronger.
The country would rather not have to pay $100,000, but and they'd rather, how do you do that? You hire Americans.
It really just makes me hesitant to consider working in the U.S. Makes me want to explore opportunities in other countries outside of the U.S. and definitely looking at Canada.
Recent grads are not, will not be in a position to be able to justify that $100K upfront that the visa is going to require.
Could Trump's new H-1B visa fee push top talent to Canada? That question is being asked in lecture halls, startup incubators, and boardrooms across North America. In late September 2025, President Donald Trump signed a proclamation that fundamentally reshapes America's approach to high-skilled immigration. At the heart of this shift is a $100,000 annual fee for the H-1B visa, the work permit that has allowed hundreds of thousands of engineers, software developers, and scientists to build their careers in the United States. Alongside it, the administration unveiled a so-called Gold Card visa costing $1 million and a Platinum Card for $5 million, framed as luxury pathways to U.S. residency. Trump argues that these measures will protect American jobs and wages by discouraging companies from hiring cheaper foreign labor. Yet, as the policy begins to ripple across the economy, questions are mounting. Will this actually safeguard employment at home, or will it undermine America's long-standing advantage in global talent? Early signs suggest that Canada, America's closest neighbor and competitor, may be the unexpected winner. The H-1B program has long been a cornerstone of U.S. innovation. It grants temporary work authorization to foreign professionals in specialized fields such as engineering, information technology, biotechnology, and finance. For decades, U.S. companies have relied on it to fill talent shortages. According to U.S. Citizenship and Immigration Services, more than 70% of H-1B petitions in recent years have been filed on behalf of workers from India and China. For big tech companies, the H-1B is not optional. Microsoft, Google, and Amazon all recruit heavily from universities and research labs abroad, and they bring in top graduates from Canadian schools, such as the University of Waterloo. Since the 1990s, Waterloo has sent as many as 1 in 10 of its graduates south each year, supplying Silicon Valley with a steady pipeline of software engineers. By attaching a $100,000 annual fee to this process, Trump's new rule creates an economic filter. While trillion-dollar giants like Amazon and Google may still pay the cost, early-stage startups simply cannot. Venture capital-backed firms that once dreamed of hiring the brightest global minds will now face a barrier they cannot climb. In practice, this means America risks losing the very ecosystem of entrepreneurial dynamism that has defined its global leadership in technology. The most immediate consequence is uncertainty. For students finishing graduate degrees in artificial intelligence or cybersecurity, the new fee changes the calculus of moving to the U.S. dramatically. Many say they cannot justify the idea of a six-figure annual cost attached to their employment. This policy also strikes at startups. Each year, roughly 85,000 new H-1B visas are issued, but small firms will now find themselves priced out. Big tech can absorb the cost, but smaller innovators cannot. Analysts already warned that some U.S. companies may shift development work to India or expand their research teams in Canada, where the visa landscape is less restrictive. For Canada, the opening could not be clearer. Universities like Waterloo already rank among the top training grounds for global technology talent. Each year, hundreds of its graduates weigh offers from Silicon Valley. With the new H-1B fee, many will now look closer to home. Cities such as Toronto, Vancouver, and Montreal are already thriving tech hubs, supported by Canada's Global Talent Stream program, which can process skilled visas in as little as 2 weeks. Prime Minister Mark Carney has described this moment as a great opportunity for Canada. While his government has not yet unveiled a detailed strategy, the political message is clear. Canada can market itself as the open, affordable alternative to the United States. With express entry, the startup visa, and generous pathways for permanent residency, Canada already offers a friendlier environment for ambitious young engineers and scientists. The difference is particularly sharp for startups. Canadian firms raising their first rounds of venture capital no longer face the same disadvantage in recruiting against Silicon Valley. Instead, they can argue that staying in Canada avoids the crushing cost of the H-1B. For the first time in decades, the talent equation may tilt north rather than south. Trump's policy was designed to protect American workers, yet in practice, it risks weakening the very sectors that power the U.S. economy. High-skilled immigrants are not displacing local workers. They fill gaps in areas where domestic supply is insufficient and generate new companies, patents, and tax revenues. By discouraging their arrival, the U.S. could see an erosion of its innovation base. Canada, meanwhile, stands to gain by keeping more of its graduates and attracting talent from abroad. If even a fraction of these workers redirect their ambitions toward Toronto or Vancouver, the economic impact will be significant. America may end up with fewer engineers in Seattle, while Canada becomes stronger in Waterloo and Toronto. Adding to the confusion is the legal landscape. Immigration lawyers have already filed challenges arguing that such an extreme fee exceeds the executive branch's authority. Courts may ultimately block or modify the policy, but the damage to confidence has been done. For companies weighing where to build their next research center, the perception of instability matters as much as the actual rule. Meanwhile, Congress is signaling a willingness to revisit the rules for both H-1B and L-1 visas. Bipartisan senators have introduced bills aimed at reform. This creates a climate of unpredictability. For firms making multi-year investments, uncertainty about visa costs is itself a deterrent. Big tech is lobbying heavily against the change, arguing that curbing skilled immigration hands advantage to rivals abroad. Whether they succeed or not, the episode shows how immigration has become a flashpoint in Trump's second term. Looking ahead, the stakes are not small. The global race for talent is intensifying. The European Union is expanding its blue card system. Australia continues to offer streamlined visas for skilled workers. If the United States erects barriers while others lower them, the balance of power in innovation could shift. Canada's opportunity is especially strong because of proximity. For workers who once dreamed of Silicon Valley, Toronto offers a comparable tech scene with easier access. Major U.S. firms already operate large campuses in Canada, from Google in Kitchener-Waterloo to Amazon in Vancouver. If Washington makes it harder to bring talent into the U.S., those same firms can simply expand north of the border. The broader picture is that talent, like capital, flows to where it is treated best. In the 21st century, economic power will be determined less by who controls trade routes or resources and more by who attracts the best minds. On that front, the United States risks trading away its edge.
So what does this all add up to? A policy designed to defend American jobs may end up exporting them. By attaching a $100,000 annual fee to the H-1B, Trump has placed a toll booth on the highway of global talent. While the intention is to slow the flow, the result may be to reroute it. Canada, with its open arms and lower barriers, could be the beneficiary. Universities, startups, and entire cities may find themselves enriched by talent that once would have gone south. For the U.S., the longer this policy stands, the greater the risk of falling behind in the only competition that truly matters in the modern economy, the competition for human capital. Trump promised to put America first, yet in the arena of innovation, this move may put America second. Could Trump's new H-1B visa fee push top talent to Canada? The answer is becoming clearer every day. This is not just an immigration story. It is a story of economic strategy, and it may be remembered as one of the most consequential backfires of his presidency.